Hello, I hope everybody can hear me. Here we go. Yesterday we started talking about partnerships. Partners, does that mean two? Two or more. I mean, we all could be partners, okay? Partnerships, there's pros and cons to each of the types, but let's just rip through some of the very overall looks at each of them. If we have a regular partnership, two or more people that are general partners, no one's in a bubble, okay? This is unlimited liability, where if the partner is in the business sense can't pay debts, then we would attack the personal pocketbooks. Okay, there is no bubble here. And tell me again what that means, especially as Jen, oh, it's already beeping at me, you guys. As Jen is new to this content, what does it mean to not be in a bubble? Your personal money is not protected. There's no bubble surrounding you, okay? These three, there is some sort of bubble, some bubble in some capacity, okay? If we go to a limited partnership or an LP or an LTD, you see both of those phrases used. The general partner is still the same as what happened over here, but anytime you see the word limited, those folks are in a bubble. Meaning those partners have protection from personal debt or personal money being attacked. Tell me about limited partners in LTDs. Yes, they're in a bubble. No, what can't they do? They cannot be in management. As you move over to LLPs and LLCs, LLPs all are in bubbles. LLCs, they are also all in bubbles, meaning their personal money is protected. The difference between an LP and an LLC is that these people, yes, can participate in management. LLPs and LLCs are very expensive to create. Where does the expense come from? Lawyers. You're going to have to sit down in length for these lawyers to help you form these LLCs or LLPs. Okay? There's a lot of protection there, and there's also going to be a lot of paperwork that goes with that. Yes. They're kind of their own boss. Because remember, it's like the lawyers, the dentists, the doctors, and so they're kind of their own boss. Remember, I'm the bad doctor. And my tainted approach to being a doctor didn't affect you guys as doctors. My malpractice didn't affect you. So they're all kind of their own boss. Make sense? So that was a quick look at yesterday. Did that help? Jen, if you need further instruction, certainly have a classmate or myself help. So what we're going to do next is a quick end of chapter. I just want you to do questions 1 through 4. You can find those on the book page 593. There is not like an exercise or problem that we're going to do with this. So why don't you quickly do questions 1 through 4. I'm going to pause my recording because my microphone's beeping at me like crazy. And then we'll go through the answers in a bit. Questions 1 through 4 on page 593 in the book. So let's look at answers 1 through 4. Again, my answer key is a lot more involved than what your answers would need to be. 2 or more people who, with a simple handshake, could start a partnership. With a simple handshake, you'd probably be general partners, okay? You should really have something in writing, though, and even take legal action to have a lawyer kind of rubber stamp that you're official. Any involvement with the lawyer, though, will have money involved. It's its own legal entity, it's its own accounting entity, but it's not a taxable entity. That was one of the first slides from yesterday. A partnership does not have an unlimited life. It can be ended either voluntarily or involuntarily. Certainly if a partner dies or if one withdraws or one comes on. So the life of a partnership is technically indefinite until it would be dissolved or the partnership would change. And then co-owners of property, as you become partners and you bring assets to the table, be it cash, be it equipment, be it inventory, whatever, it becomes the partnerships. Number two, a mutual agency is simply a characteristic that means that the act of a partnership is binding. Like the whole example of me buying a snowmobile for Ben and Jenny's ice cream shop. So I have to act within means of what our business does if I want it to be like a business transaction. Unlimited liability is not a bubble. That means if we've got debt and we can't pay it as partners from the business, then we're going to have to start using our own pocketbooks to do so. There is no bubble there. Number three, certainly there's advantages. We didn't really talk about the pros. We talked more about the disadvantages or the monetary pieces to partnerships. You know, if Ben is really good at selling ice cream and I'm really good at managing the books, we're going to make a great partnership because we're each capitalizing on each other's skills. And kind of what one can't do, the other does. And so that's, you know, and we looked at famous partnerships yesterday. Steve Wozniak was the brains, and Steve Jobs was the beauty. And I think we as consumers kind of only associate Apple with Steve Jobs, but there's more to that story. And it's typically people combining their skills of what they're good at. It's easy to form. Like I said, we can handshake today and we're partners. I'd certainly recommend that legal action or something in writing. You become free from government regulations and it helps make decisions easier. Some disadvantages, when I bring my cash to the table, it's the businesses now. And so that concept of a mutual agency where it becomes the businesses. If it's got a limited life or certainly unlimited liability, in other words, no bubble, can get to be really scary. And number four, a limited partnership is usually a bubble. Limited partners kind of answering the question that, well, no, that was LLP, not LLC, sorry, Emerald. Limited partners have limited personal liability as long as they don't participate in management. They're kind of their own bosses, but LLCs, of course, have the option to be managers. So those were the four that kind of go with the first section. I am going to move on to the next section, but I got to let my headset juice up again. Okay, as I just shared with your classmates, we are moving on to section 12.2. Although there's 3 bulleted points there, we're only going to talk about how you form a partnership, do some coordinating journal entries, and that's where we're going to end. I'll talk about how we divide net income and loss tomorrow on Wednesday. So forming a partnership is a huge accounting activity because we have to form the partnership. At year-end time, we have to divide either our net income or hopefully not our net loss. And then we have to prepare things for a financial statement. Like I said, we're only going to cover the first bulleted point right now. So A. Rolfe and T. Shea decide they are going to take their sole proprietorships and transform them into a partnership. So they each have been running their own businesses by themselves and decide 2 is better than 1, and they're going to form a partnership. And they're going to name it US Software. Rolfe and Shea have the following assets prior to the formation of their partnership. Do you have this little visual in your notes? Good, 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 good. So as you look at book value versus fair value, book value is what it's worth right now. Technology's not my friend today here. Do you guys see these handwritten notes? Oh, okay. Well, book value is what it's worth. Fair value is what they decide on. What they, as managers, decide is what's, or excuse me, owners, what they decide that's fair. So notice cash doesn't really change. A. Rolf brings $8,000 to the table. T. Shea brings $9,000. And as we decide, that's what it's worth, and then that's what we decide is fair. That cash value stays the same. Okay. As we look at equipment, however, which partner had equipment that he or she was bringing? T. Rolf, or A. Rolf, excuse me. It's got $5,000, but accumulated depreciation dies at the time of a partnership formation, okay? And so they say, all right, you've got this $5,000 piece of equipment. We've got accumulated depreciation offsetting it. We're going to go ahead and put your fair value. We're going to agree that your equipment is worth $4. We kind of absorb that accumulated depreciation into it. And then AR, that's a nice asset to bring to the table. People owing us money, right? But we still better account for it. T. Shea has AR at $4,000, but why are we offsetting the allowance for doubtful? Because we might not get all of that. But then notice that's what it's worth. We bring it over here, and the partner must have said, I'm nervous. You're no longer a sole proprietorship anymore. We're now a partnership. Let's up that contra account higher because we may not see some of that. So do you see how book value differs from what they decide on, fair value? So now we have to journalize that. And as we get ready to journalize, this is a really nice slide for deciding what follows into the partnership and what doesn't. Notice on that equipment, I don't know why I can't write, you guys, whatever. On the equipment, you kind of absorb depreciation into equipment and start at a new value. But AR, you're going to have that contra asset going with it. So equipment doesn't have its contra asset that tags along, but AR does. Because I'll go back here. You'll notice the 5,000 minus 2,000, they decided, well, 4,000 is the new value of the equipment, end of story. But as we brought AR over, we're going to actually up the contra asset because we're worried about it, the formation of the partnership affecting that. So this is a really important slide to take note of. What comes with a partnership creation, what does not? So as these two partners sit down, shake hands, hopefully a lawyer is around, we're going to create the first initial investments from each of the partners. A. Rolf, what was he bringing? Let's just call him boys. Bringing cash and equipment. What was T. Shea bringing? Cash and AR. What a lovely asset to bring. Debt, right? Someone owing us money. Here's what we've got. Cash is going up. Now, whose cash is going up? I'm going to still try to write. Oh. The businesses. The businesses is going up by $8,000. Equipment is going up by $4,000. Are we going to see the contra asset on this one? We are not. And then A. Rolf Capital is worth what he brought to the table. As you look at T. Shea, he brought $9,000 cash. AR valued at $4,000. What credit are we going to see here before we see your capital, though? We are going to see $1,000 offsetting that AR because we're worried we're not going to see it. But what's really cool, look at how their capitals match. Do you see how A. Rolf is at $12,000, T. Shea is at $12,000? What kind of partnership do you think they have as far as a percentage? A 50-50 split. Very good. Nowhere in there does it say what kind of partnership they formed. Is it an LC? Is it an LP, an LLP, an LLC, a general? We don't know, but they're a 50-50 split. Now, if I go back a ways, we might say, well, maybe they wanted to be 50-50 partners. So we're going to force these assets to be valued so we are at a 50-50 split. So I think that's part of the conversation as they look at book value versus fair value. They want to know the end game of what do we want as a partnership percentage. And they wanted 50-50, where you see the 12 and the 12. Was that pretty easy? I think so too. So let's do 2 brief exercises. Brief exercise 12.1. Everything is going to have to be on the notebook because you don't have workbook pages for this chapter. Brief exercise 12.1 you can find on page 594. So we've got Barbara Ripley and Fred Nichols decide to organize the All-Star Partnership. Ripley invests, Nichols contributes, and has some equipment. All they want you to do is prepare Fred Nichols' investment. So although there's 2 partners, they want you to just do Fred Nichols' investment journal entry. So Fred's bringing cash and he's bringing equipment